Hello and welcome. My name's Stephen Dickens. I'm your co-host of what is now episode 2 of the Fat Tailed Thoughts podcast. Morning, Jared. How are you?
Morning, Steve. We made it. We
We
made it
made
to
it to
episode
episode
two.
2 without breaking anything. What happened, man? What?
Wait, maybe we'll fix that on this episode, Steve.
Yeah, maybe we'll blow up the internet
There we
on
go.
episode 2, right? So great newsletter again this week. I think a fantastic topic. This is going to be a lot to unpack in 30 minutes. So let's just dive straight in.
Let's do it.
Generational wealth transfer.
It's a big topic.
It's a big topic. So get us orientated first. Let's just get some ground rules around what we talk about when we're talking about some of the generations, frame the topic, and then we'll just go from there.
Let's do it. So I'm actually going to jump, Steve. I'm going to jump all the way to the conclusion, then come back, just kind of lead the witness here. So what we have going on is we have older generations who have a substantial amount of wealth. We have younger generations who don't, and in many cases have a lot of debt, which kind of compounds it. As those older generations are passing away, boomers and so on, we have a wealth transfer, 68 trillion, Steve, 68 trillion that's expected to move over to these younger generations over the next 25 or so years. I mean, that is just massive amounts of wealth. So that's going to create some super interesting dynamics that we're going to start to look at. One is that we've still got a fairly substantial and actually increasing socioeconomic divide in the country. So that wealth transfer is not happening equally. That's going to be a story of have and have not, which is going to be quite interesting to explore, and we'll see how it plays out. Secondly, the folks that are inheriting that money, they're different than the people that have it today. Their wants, their needs. This is a digital generation, or rather generations. So how they spend, how they invest, the types of services they want, very, very different than what came before. So we're going to go right on into it. Steve, I think I got you on mute.
So let me just summarize that. Make sure I've got it. This is, and we'll make it you and me. This is our parents retire out. What's happened to me in the last 3 years? Both my parents have passed away. Generational transfer of wealth, inheritance, money moving from generations to generations. And I think your point is, I'm different to my parents, and my kid's going to be different to me. And what do I buy? What services do I want to consume?
Exactly.
What's my attitude towards debt, savings, investment strategies? Is that what we're talking about here?
It's a big shift. It's a really big shift, and that's really on the have side. And we have to have the conversation. I mean, it's just the bottom 50% socioeconomically. The bottom 50% are set to inherit about 8% of the total wealth that's being transferred. I mean, that's a wildly small number, which is we'll get into. We've got fairly hard research that demonstrates kind of the existing structures in the U.S. perpetuates dynastic wealth, meaning it stays within families. Rich get richer, etc.
So talk to me a little bit about the 68 trillion. You mentioned that number, and that's a headline that's going to stop people. So unpack for me where that number comes from, and sort of talk to me a little bit about that boomer generation that's got hold of that 68 trillion right now.
Absolutely. So it's reset. So we've kind of got two major generations we got to talk about. We've got about 6 generations kind of all living together right now. If we go all the way back, we have the silent generation. Those are the folks that plus or minus grew up during the Great Depression. They basically up and through World War II. They and their parents, the kids, became the boomers. And as folks are coming home from the war, you get this massive population spike, which has led to this echo generation of millennials and more recently Gen Z. Basically, as you got that population spike from the World War II folks coming home, the boomers then had, by virtue of being bigger, had even more kids, and we end up with a large population. But over that time, the country has changed dramatically. So right in the middle of all this, you have kind of what I would call a transition generation, Gen X. And they're neither boomers nor millennials. They're that in between.
It's me. It's me. I'm looking at the newsletter on the right-hand side here. Age between 38 and 53. I'm rapidly getting towards the top of that group. I'm older than you, Jared.
I think so. I fit right in that millennial, right in the middle of there.
Oh, okay. So I mean, this is a good way to get people calibrated. So my parents were boomers. My grandparents were that silent generation. So that's a kind of, I'm 48 in a couple of weeks' time, just to get the listeners who don't know me orientated. So that just gives you a sort of perspective of kind of where those generations play out.
Interestingly, my parents are boomers, my grandparents. So we actually generationally the same, even though I slipped over into millennial, Steve.
Well, you're just younger, better looking, and smarter than me, Jared. I'm going to have to wear this burden throughout this podcast every week. But no, I mean, all joking aside, so we've not got calibrated on that 68 trillion. Where's that number come from?
So that number comes from the wealth that's been accumulated in part by the silent generation, but largely by the boomers. And this is not only because they are a large generation in terms of absolute numbers, but also atypically for this country's history, they have accumulated a much larger percentage of the total wealth in the country than any generation in recent memory. So what you have going on is kind of you're getting hit twice in terms of the overall makeup. Once, it's a lot of people, and I'm just by virtue of it, they'd all been average, it would have been a lot. But two, on a per person basis, it's a much larger percentage than before.
And are those drivers, is that because that's the generation that's benefited most from property appreciation? You know, that's probably the first generation that's had access to, readily available to invest in the stock market. You know, there's been pensions. You know, is it just a sort of aggregate combination of those factors?
The aggregate congregation is a good way of putting it, Steve. There are a huge number of drivers, but if you look at basically the post-World War II boom, if we can put that, which plenty of ups and downs in between, but the quote-unquote economic stability you saw from post-World War II through really up and through 2008, 2009 with some blips in the early 80s and such. That it's that generation that really benefited from it, came of age, went to college at a time when college was still relatively cheap by modern comparisons, healthcare relatively cheap, long run of the stock market relatively strong. We continue to have houses and the move to the suburb, the American dream of owning your own house, etc. Basically timed it right, so to speak.
And that's one thing that came through from the newsletter as we sort of go to that sort of millennials and post-millennials. You mentioned the word debt there. You mentioned college, particularly from a US perspective, what that means. Just expand on the difference between, I suppose, sort of my parents' generation, my generation, and kind of the generation that comes after me. Yeah, what their debt levels look like, because I know that's a key sort of. There's the plus side of the equation, but there's also the negative side of the equation. So just expand on that for me a little.
Absolutely, and then Steve, you're right. It hits on both kind of debt and wealth, and it's again for millennials, it's a bit of a 1-2 punch here. Not in a good way. If we look at Gen X, following the boomers, on average has much higher debt levels, but also has relatively high wealth levels. So what you're looking at is unlike the boomers who have done quite well in the absence of leverage, Gen X plus or minus kept up with boomers in terms of wealth creation, but did so by taking on substantially more debt than the previous generations. The millennials, if we think about that generation, kind of 80s into the early 90s, they grew up through the crash of the 90s. They grew up through 08, 09, then the subsequent Great Recession. This is a group that have kind of effectively mistimed and gotten hit multiple times over, concurrent with rising healthcare costs, rising education costs. So what you see in millennials is you see a lack of wealth and an enormous amount of debt. And in fact, of the generations alive today, this is quite painful. Millennials are unique in that they have more debt than wealth on average. Everyone else, all the other generations, multiples of wealth versus debt, and millennials are the reverse. That's a deep hole to dig out of, especially considering how young millennials are on average.
So if you look at that propensity of debt, and then they're going to be the net inheritors of that 68 trillion worth of wealth transfer. Explain to me your thoughts on the mechanics. So let's try and make this, because we're talking in the abstract here. Let's pick on somebody a little younger than you and a lot younger than me. Somebody who's maybe like 25.
Yep.
Parents have passed away, unfortunately, and they're now just going to inherit some money. They finished college 2-3 years ago. They got a couple of $100K's worth of college debt. They're trying to get on the property ladder. Yeah. Let's just frame because I think the newsletter does a very good job of taking this out and looking at it from a broadest lens. But let's try and humanize it a little and sort of pick on that 25-year-old just to explain some of the concepts if we can.
Absolutely. So I think the place to start here, Steve, is that 25-year-old on average is probably not going to inherit a lot. Because the averages here don't tell the whole story, even though we start with that 68 trillion number. If you start to break it down, the bottom, as highlighted in the intro here, the bottom 50% socioeconomically, which by definition is half the country, is set to inherit about 8% of the total wealth that's being transferred. That's wildly small compared to what is you start to look at the top 1%, top 10%. Are set to inherit. So on average, that 25-year-old is likely to basically continue with the debt without any newfound wealth that would, in theory, offset that.
Their parents aren't going to leave them with enough to clear their dets and change their... So 50% of that group of 25-year-olds is getting 8% of the $68 trillion. Right. That's not enough for them to have a sort of life impact to change their debt structure and kind of change their world. Let's maybe pick on another 25-year-old. You know, both parents were doctors, lawyers. They're not rich, but they're wealthy. Yeah, you know, they're doing okay. They're maybe in that sort of net family income, sort of $500,000 plus when you look at the parents. Let's kind of pick on that group.
Well, so for that group, Steve, we've actually, and we're going to start getting into a tax conversation here as we go up the wealth ladder. For somebody who is set to inherit, actually the average inheritance over the last 20 or so years has been increasing much faster than inflation. So what we're seeing is for folks that are inheriting, and the Federal Reserve of St. Louis does some great studies on this that they keep regularly updated. We're seeing steadily increasing amounts of wealth. Now, where this is interesting, Steve, just coming back to the debt conversation is, yes, more is being inherited, but it's being inherited by a generation that's inherently poorer. So where this can get funky is if we see that generation deploy wealth similar to the way previous generations did, investing in stocks and bonds and so on, that's one path it could take. But another path it could take is these are digital natives, Steve. These are folks that have now more recently grown up with Bitcoin and cryptocurrencies and the like, who are growing up with venture capital becoming an industry unto itself and the ability to invest in startups and the like. These are folks who what we've seen, and robo-advisors, for instance, a very different demand for the types of assets they want to invest in and the types of services they want to engage to actually invest those dollars. That could be very, very interesting to see how and when that might shift as they come into new wealth.
So one interesting thing that struck me when I read the letter was, you know, the classic 60-40 stock, bonds, portfolio construction. You look at, if you're a digital native, you know, you're on Robinhood, you're on Coinbase, you're on Gemini, Kraken, Binance, you know, what insert your crypto trading platform of choice, you're more risk averse. Some got a higher propensity to take on risk, I think. So, are we going to see chasing returns? So let's pick on this 25-year-old. They get their $200K in college debt, and they're inheriting a couple of $1 million. The family house, some savings, a couple of $1 million. So they're able to clear that debt, able to jump onto the property ladder, and they've got some sort of addressable wealth that they can do something with. That investable component of that, I came away from the letter thinking that they're going to be more willing to take on risk and invest differently than their parents did, because we get more conservative as we get older. That's, I've got no stats to back that up apart from just experiencing my own journey. Is that a dynamic, do you think?
Absolutely. And we're seeing a couple different things. Let's start with different, and then we'll start with asset class. Different, we're seeing that the types of services and the types of assets change significantly. You have a whole bunch of startups who are slowly but steadily growing assets under management. You can go invest in basically as a managed service. You can go invest in art now, blue chip art. And again, the fund manager goes and buys the art. You have slices of that fund. Certainly, if you have a couple $1 million, you qualify as an accredited investor and you have access to that type of thing. You can go and invest in startups, not even with necessarily the big name VC companies. You have these angel groups and the like. You can do it directly. You can do it via syndicates as well. Never mind all the startups that are allowing folks access, like Kickstarter and the like. But even beyond that, we're seeing kind of even the traditional equities world get shooken up by the likes of robo-advisors. And this again comes, remember, millennials have had a very different experience than the generations before. Many of them, and certainly as we get into Gen Z, can't remember a world without a phone in their hand, can't remember a world without access to the internet. Why would you ever get on the phone and talk to somebody if you can just do it yourself? What am I paying an investment manager for if really what I want is an ETF that just follows the market? If I want to take slightly more risk, slightly more sophisticated, it would seem that somebody could actually, an algorithm could understand me and match me up. Maybe I'm interested in companies that have more than half the board is female. Maybe I'm interested in companies that are putting environmentally friendly agendas at the forefront of their business. These are all things, Steve, that companies have to disclose in their annual reports and in their other filings. What that means is you can build an algorithm to read this, to select them for you, and to automatically allocate capital to them. What we're seeing is this remarkable rise, Betterment and Wealthfront and the like, with these robo-advisors. But then we're seeing the big guys, Vanguard and Charles Schwab and whatnot, basically being forced to get on board with this because they're seeing these young upstarts and going, oh God, the folks who money's being transferred for, they don't want to talk to us anymore. What we're seeing, Steve, with these robo-advisors is we're basically seeing kind of in the 90s, the boomer generation, electronic trading and day trading and through the 90s was the big thing. What we're seeing now is a shift to more passive investing, but something slightly more sophisticated through the robo-advisory, but still remarkably low fees.
So the point is there's a huge amount of money transferring through the generations. The generations that are inheriting that wealth have got a different mindset, coming from a different place, got different perspectives on portfolio construction, different perspectives on how they're going to invest it from a mechanics point of view and the tools they use and the asset classes they put it into. What's the impact? You mentioned it a few moments ago on the tax system.
Yeah.
And I think that's another key component in the letter for me. Talk me through your thinking there and kind of tax becomes political very quickly, and I don't think we're trying to be a political show here, but just talk me through some of the mechanics and some of the challenges.
No, it won't be recommendations, but Steve, it's important to highlight nonetheless. So in terms of that experience and what those natives want, one thing that may change, Steve, but just before we get to taxes here, is that the risk appetite that you hit on before may shift as millennials come into wealth and Gen Z come into wealth. What's interesting here is right now we've seen a propensity to take on more risk. We don't know if that will stick around as they age and as they take on more wealth.
And so is that, Jared, because they've got to dig themselves out of that college?
That's exactly.
Is that what it is? I mean, I'm sorry to jump in here, but if you're coming out of college with 200K's worth of debt, you got to go and check. You can't be 2, 3, 4% returns because you're just not going to get there fast enough. So is it basically, I've got to go and chase the next meme stock, the next altcoin, because I've got to have that sort of 100% return because I've got to make this appreciate fast enough to get myself out of this debt.
That's exactly right. There is definitely a swing for the fences mentality here, especially if you can provide that potential upside through a service that, again, is digitally native, you can do on your phone, gamified in the sense that so on, basically checking all the right boxes. Not only can you offer somebody this chance to swing for the fences, which may get them out of that hole, but you can do so through an experience that, let's be frank, is more exciting to somebody who's lived their life on the phone. It's more of a video game than it is the kind of traditional staid legacy players who have been advocating for ETFs and so on for many generations. That's not saying they're better, simply saying they've found a niche and a way to differentiate that service that's inherently attractive. That's simply not, it's way more exciting than going and sitting down with your financial advisor in an office and talking about a 60-year plan about how you can grow something at 5, 6, 7% a year and it'll double every 10 years.
Yeah, it's the gamification of finance. It's, can I go on to Wall Street Bets on Reddit, find some unique information, plug it into my phone,
stick it to the man.
Yeah, and roll it from there. So,
well, let's come back to that taxes, because that was so that's, again, we need to break this out though, because we've veered into the haves, the folks, that 25-year-old who might be getting a couple $1 million. We've got groups on either side of that individual. We've got folks who are going to come into way more money than that. We've got folks who are going to come into little to nothing. And it's important the experiences of those groups will likely be quite different. Let's start with the tax structure and explain why this is likely to continue. Right now in the U.S. at the federal level, estate taxes kick in at just shy of $12 million in inheritance. Just for clarification here, estate taxes, inheritance tax, fundamentally, we're taxing the same assets. They're getting the thing that's getting passed down, but it can change whether the quote unquote estate pays it or whether the individual pays it after they've inherited the wealth. We're just going to put that to the side. You'll likely see both. And it changes a couple of states tax differently as well. But what that means, Steve, that $12 million mark, is that as long as you're at the federal level, if you're passing down stuff less than $12 million from a tax perspective, you're pretty much in the clear. But above that, you start paying taxes on what you're passing down. Well, Steve, let's be realistic here. If you've got $12 million, you can probably go pay a lawyer who can go irrevocable trust, however you're going to structure that thing. You're probably not going to be paying those taxes.
And that's the key point here for me. I don't, and I tweeted about this in the week off a thread I was on. I don't think the tax rates are inherently wrong. For me, the tax code is just too long a document. And I'll explain my thinking here. I'm going to go on a rant for a moment, so beware, listeners.
All right.
So the public discord and the narrative is, 25%, 30%, 40%, the rates at which we should charge particular individuals. I don't think that's the right conversation for us to be having at all. yes, you should get taxed more as a percentage if you earn more. So if you're earning, millions of dollars, you should pay more tax percentage than you should if you're earning,
Of course.
single digit tens of thousands or whatever the numbers are. I think the point is we've created a tax code specifically in the US, and I've had to learn this experience over the last 7.5 years, that is labyrinthine in the extreme. The amount of words in the tax code is the problem. Because if this was a 100-page document, not a thousands and thousands of page document, there wouldn't be the loopholes.
Yeah.
And I think where the problem comes from, with the classic Buffett saying he pays less tax than his secretary, is not because of the absolute percentages, but just the mechanisms available to the uber wealthy to avoid paying tax. Rant over.
No, Steve, it's a good point, but I'm going to take it a step further for you, because we actually have things to hell with loopholes, so to speak. We have things built in explicitly into the tax code that are regressive in nature. Really good example of this, and got it credit where credit's due. Cliff Asness of AQR had a really good set of thoughts on what's called the carry forward basis. So, Steve, imagine that 25-year-old is inheriting a couple of million. As part of that, there's a business in there. There's companies. Let's say they bought Apple at what's now $5 a share, and it's now trading at $150 a share. When that individual inherits that Apple stock, as opposed to when they choose to sell it, owing taxes back to when it was originally bought by their parents or grandparents, that the tax basis is, quote unquote, stepped up to the price when that person inherits the asset. Steve, what this means is that somebody, your parents, grandparents, could buy Apple at $5, put it in the inheritance, grandchild inherits it, sells it, make it the massive gain, the full value, however many millions of dollars that is, and pays zero taxes on it. That's wild. That is wild. That is mass. That is exactly how you establish dynastic wealth.
Yeah. Your parents bought 1,000 Apple stock on the day it listed on the NASDAQ.
You got
for
it.
a couple of $1,000 because they bought the new desktop and thought, hey, this company looks cool.
You got it.
Not realizing they're dealing with one of the 5 mega companies that's got over $1 trillion worth of market cap. And the share price was going to go on a 30, 40-year explosion, and they're not, and the kids don't pay tax on those gains.
Yeah,
I mean, those to me are some of those, maybe loopholes the wrong word, but those are the paragraphs in the tax code that don't ever get discussed, which is where the fundamental problems lie.
That's exactly right, Steve. And we get really good research from the Fed that demonstrates that the tax code as it's set up, wealth tends to perpetuate wealth, the wealth get wealthier, et cetera. And just even a cursory read of the tax code and the issues it becomes pretty obvious. Cliff, I think, made a really good point, which is kind of part of that argument going back to how to reform this. Some of the suggestions, well, tax it at death. That can get pretty ugly. Mm-hmm. If, say, your family owns a small family business, and let's say that's what you're inheriting, it's a restaurant, the like. If we tax that, you may simply not have the cash, even though that's worth something on paper. You may not have the cash. You could be a forced seller. That could be enormously destructive. Cliff, I think, made a really good point, which is simply to get rid of the carry forward basis, but allow the individual inheriting the asset to defer the taxes until time of sale. What that means, Steve, is in the event that my parents start a restaurant, I inherit the restaurant. As long as I keep operating the thing, I'm not going to owe any new taxes on it. If I choose to sell that, then I will owe taxes all the way back to the start.
That's the taxable.
But I have cash to actually pay it off.
So we're getting close to time here. Summarize up, and I think from reading the letter, and this could have quite easily been 3 letters, I think, just given the size of the topic. Yeah. And I know you've done that in the past, and I think this maybe was on the cusp of there was so much.
It was.
What are the key things that so we've got this generational wealth transfer I've had this happen in the last 3 years. The sort of parents pass away, boomer wealth transfer. What are the top 3 things? And you're going to have to be quick and single sentences. What are the top 3 things that we can expect to see over the next maybe 10 years or so?
Absolutely, Steve. So one, you're going to have a substantial portion of millennials, not a majority, but substantial portion of millennials and Gen Z who currently are not wealthy come into tremendous wealth. And again, their demands, the types of assets they're interested in, how they want to consume those investment products is very, very different. So that's going to be a major shift for the industry. It'd be the first I'd highlight. The second thing I'd highlight is you still got the bottom 50% who probably will not come into wealth. I'll highlight that because that's going to exacerbate current socioeconomic strife. That's likely you're going to have this intragenerational strife now where you have a bifurcation of the millennials, those who do and don't inherit. That's no longer railing against the man, that's railing against your peers. And it's going to be very interesting for the political discourse, especially of how does that actually get resolved when it's no longer some quote unquote old person that you can just yell at and it's your peers who are struggling now. How does that get resolved? The third thing I'd highlight, Steve, is this is what we're trying to predict the future here. That's always a really, really difficult task. What I would expect to happen is with this amount of money moving, with folks now having new experiences, whether it's because they came into wealth or whether it's because they're now seeing their peers come into wealth, but they don't have it, you're going to see an explosion of new services offered. The robo-advisors, the new asset classes are kind of tip of the spear here. Those who on the fintech side can go build companies to service this, those on the political side who can tap into this narrative, it's going to be really, really powerful. Hopefully that becomes a positive economic driver so that we see new businesses develop, new services, new experiences. In the lack of that, Steve, you could end up with substantially more conflict between the haves and have-nots than we do today until it eventually gets resolved.
Well, those weren't single sentence answers, but they were a really good summary nonetheless, Jared. I mean, I think of a huge topic. If you've not read the newsletter and you're coming into this topic the first time through listening to this podcast, go read the newsletter. You've been listening to the Fat-Tailed Thoughts podcast, brought to you by Stephen Dickens and Jared Klee, where we summarize every week the newsletter that we put out. If you like the show, please click and subscribe. Tell your friends about it. That helps the algorithm and help us grow and help us really bring more content to you. Check back next week when we'll see the newsletter drop midweek, and then you'll see the podcast drop at the beginning of the week. You've been listening to the Fat-Tailed Thoughts podcast, and we'll speak to you soon.